Good afternoon, everyone. I want to welcome you all to the Tax Resolution Help Center. My name is May. I will be hosting today's session and introducing today's speaker. I will also be coordinating the Q&A chat session at the end of this session. I want to congratulate all of you for taking steps to deal with your taxes. Taxes from all sources, including income tax, payroll tax, property tax, excise tax, and sales tax represent a 35% to 60% reduction in your personal savings and wealth. As you probably know, those with 1% of the wealth in this country have experts to help them pay a small percent of tax. Our goal is to help you reduce how much you pay in tax by educating and informing you on ways to reduce past, present, and future tax expenses. We think you are entitled to live a happier, healthier life by keeping more of what you earn and getting the taxman off your back. Our goal is to provide you good information with the opportunity to ask questions that are important to you. The presentation itself will last about 20 minutes plus 20 to 30 minutes for you to ask questions by chat. I will select the questions and present them to today's expert. If you wish, you can include your first name and your state. That would be great. Other than that information, your identity is not mentioned. The information you are receiving in this session is not specific tax advice. If you want specific tax advice for your situation, you are free to contact today's expert or any of our tax experts at Tax Resolution Help Center. As you know, these group sessions are included in your do it yourself membership fee of $20 per month. If you are not yet a member, please sign up today. We need your financial support. To better understand what might be on your mind during the session, I might include some pooling questions to ask you. I will then finish with a 5-minute wrap up. Also, a survey will be sent looking for your feedback. And finally, this session will be recorded. The topic for today's session is taxes for the self employed 10 tips to minimize tax expense. The tax expert for today's session is Kelly Coglin. Kelly is a CPA, the chief executive of Everyday CPA and founder of Tax Resolution Help Center. Kelly has been a CPA for over 20 years and many self I'm sorry, has helped many self-employed business owners better manage their tax expenses by planning, company formation, and business strategy. Kelly loves to help small and medium sized business owners with past tax debt, prepare tax return that tax full advantage of tax laws, and plan for the future. With that said, introducing Kelly Coughlin.
Hello, hello, May. Thanks for the introduction. I'm glad to be here today. Let's get rolling on things. We've got quite a bit to cover here in this very short session. Taxes for self-employed people are probably the highest in the country when you include all of the taxes you have to pay, ranging from income tax based on your profits, your self-employment tax, which is also calculated on your profits. So you get a double whammy there. And of course, you've got sales tax that you have to pay for many of your goods and services that you purchase throughout the year. And you've got property taxes that you might have for your home or your business. You've got excise taxes for your automobiles and maybe some of your equipment. Um, I miss any of the big ones? Oh, you've got state income tax too, right? So all of that is adds to a big number. I spent a lot of my career working on trying to help minimize that. And here's some, it's hard to find humor a bit in IRS and tax things, but here's some of the things I come up with here. This is taken from the National Lampoon with the gun head, there's from Revenant, there's an IRS guy. This is the IRS bear approaching a guy in the shower. I'll let you do what you want with that. That's all designed to create the imagery that there's nothing good that can come out of taxes and high taxation. We get goods and services. Granted, that's helpful, but these are big numbers and they need to be managed carefully and thoroughly. So here's what happens when you don't deal with it. And what we're going to talk about briefly today, the two main types of taxes, there are five in total, generally speaking: self-employment tax, income tax, sales tax, property tax, and excise tax. But there are two that we're really going to focus on trying to zero in on for management, and that's for tax management. Self-employment tax in the W-2 employee world, that's called payroll tax. Payroll tax is normally split in half by both the employer, who pays half, and the employee that pays half. In the self-employment world, since you don't have an employee, since you don't have an employer, the employer pays 100% of the tax. Or you could say that the employee pays 100% because they're one and the same. So that's why that number is so high, 15.3%. And if you're a low income tax, that self-employment tax is even greater than the income tax. Now you get a tax deduction for half of that, but it still is a big number. So income tax ranges from 12% to 37%. You'll see that on line 15, Form 1040. Goal is to keep that number low. Self-employment tax is 15.3%. That's on line 31, Schedule C. I think my big fat head's in the way there. There it is, right? The goal is to keep that one low. So here's the some tips to focus on. On the revenue side, you want to be complete about your revenue. That is, you want to make sure that you report the totals of all your 1099 NEC, 1099Ks, 1099 miscellaneous, 1099Gs. Those typically aren't on your business return, but 1099 NECs, 1099Ks, and 99 miscellaneous. Those are normally connected with your Schedule C business. So the IRS does a match to look at the total of those 3 or 4. And if there's a match within a certain reasonable range, doesn't have to be to the penny, but probably to the dollar or two, then they'll be looking for unreported income. That's a easy match. So if you're 1099, NECs, Ks, miscellaneous, et cetera, they add up to 100,000 for the year, and you reported 25,000, you'll definitely get a letter saying, oops, there's a mismatch here. We reported your business partners reported 100,000 in revenue, and you only reported 25. 75 is missing. Maybe there's a good explanation. That's not an audit. It's just what's the cause for this explanation, for this discrepancy. Keep in mind that as long as your revenues match in total equal to or greater, you could certainly make up for some unreported NECs and Ks if you show them as deposits, cash, checks deposited. So the IRS doesn't really care that much about what the source of revenue is, 1099 or 1099K or cash or checks, even, cash deposited. But it's that total number that they're really looking for. And whether that's comprised of NECs or Ks isn't really that important. It's at a minimum, it should be, your revenue should be equal to or greater than, if you earn money outside of the NEC, the 1099 area, then you need to add that as well. So they're just looking for a quick match there. So how do we reduce the tax on that? Both the Schedule C self-employment tax and the income tax. I tell people to go, number one, certainly if you've used, accounting system, QuickBooks, et cetera, then that's great. You should be able to, if you've kept up with that, that will be in there and print a report, bingo, there it is. But most people aren't doing that. So what I encourage people to do is go to your credit card statements, cash withdrawals, checks, Venmo, PayPal, any expense that you had. Look for that to see if there is a business deduction in there. Number four, focus on mixed use expenses like a cell phone, internet, automobile, travel, supplies. Typically, those are combination of business and individual personal use. So cell phone, most people don't have a separate cell phone for their business. So do a reasonable allocation of your cell phone. Same thing with internet, automobile. Um, Automobile, if you're going to use it for business, make sure the mileage for business is at least 50% plus usage. So if your total miles are 25,000, make sure that the miles that you use for business are 12, minimum of 12.5. Otherwise, you'll lose some of the tax benefits of that. So use your car for business. It's you got to get automobiles are expensive. So in this world of shared economy where you have expensive assets, it's important to be able to use your expensive assets, whether it be your home or your automobile or your RV or your boat, use it to generate income, whether that income is for your own business or maybe it's you use it to do Uber or a ride share or that sort of thing, or Airbnb for your home. So mixed use on automobile, and there's some tricky ways to do depreciation on that. So if you need help, make sure you get some professional help there. Travel expenses. I always believe in creating a legitimate business trip out of a travel expense. If you have your own business, you're probably always working the deal, so to speak. So make sure that you work it and then use the tax laws to benefit you by deducting travel. In terms of compiling and collecting transaction information, let's just focus on the expense side for now. It's a good idea, as I said, number three there, to get your bank statements and your credit card statements. There's good information in there, and those can double as a receipt if you can't put your hands on your receipt if you didn't save that. The other thing to do is make sure, that you download all the transaction data in your bank and credit card information. I've actually built a program to help compile all that in case you don't have QuickBooks or an accounting system, where you snag the data, run it through a program, look at the transaction data, run it through a couple Excel type things, and you can compile your own financial statement from that, at least the income statement from that. It's very effective tool. Some of the banks kind of put a sunset period on the date, the length that they'll hold that data. So I recommend getting it at least quarterly, so that you have, 4 files, January through March, et cetera, that you can then compile into an annual one. Check with your bank to see how long they keep it. If they keep it for 18 months, that's great. Then you can grab 12 months, maybe 14 months, the last month, the month of December in the prior year, and the month of January in the following year. So you've got some of these transactions that checks that might have been written in December that didn't clear until January. You're entitled to that deduction if it was written in December. So I always believe in getting 14 months, January through December, and then the month before the year started and the month after it ends. Grab all that data and analyze it, and then of course keep your bank statements and credit card statements to help support that. Um, One thing to be aware of is that itemized deductions are for personal use are on your Schedule A. So if you use property mortgage in your if you use a home in your property that you own and you have interest in tax related to that, then and you also have it as a business, Airbnb, rental, something, then you'll want to have a um, mixed an allocation between how much would be on your Schedule A, which is an itemized deduction, and how much would be on your Schedule E or your Schedule C, if they're business related. Schedule C, your real estate might be on a Schedule C if you were running like an Airbnb with breakfast served and you're really running an operating business. Schedule E, it would go on there if you're just renting it out and you got passive income from that. So frequently you'll see people with uh, interest deductions, and if they allocated from Schedule A, an itemized deduction, to the amount that's on the business, they'll realize that, oh, that the amount that was on Schedule C and E actually reduced my itemized deduction, so I don't need to itemize anymore. I can take a standard deduction. That happens quite frequently. You're better off in most situations taking it as a Schedule C or Schedule E expense deduction versus an itemized deduction, generally speaking. But you want to have a good tax person that can help you with that. Retirement contributions are other good source of contributions. On a Schedule C, you can do an SEP, you can do 401k, you can do a solo 401k. There's a lot of things that you can do, but you don't want to do your IRA there. You want to do your IRA, you want to do the SEP/IRA. Your goal is to make sure that SEP is a deduction on your Schedule C, which will not only reduce your taxable income, which an IRA would also, but more importantly, the SEP is on that Schedule C, so it will reduce your profit on that Schedule C, which will in turn reduce your self-employment tax. So you'll get a double tax savings there, reduction in self-employment tax and a reduction in taxable income by making that SEP contribution. Same thing with 401k for that matter, or any other type of retirement plan that you can do. The IRA is a good tool to use, but it's the least desirable for self-employed people because you don't get it's a deduction after you've made your Schedule C contribution, Schedule C calculation, and self-employment tax calculation. Here's a quick number 9, number 10. Be smart about your business model, active versus passive. I use the acronym. I don't know if you call ACL an acronym, but if it's an active business, you want it on Schedule C if there's a loss. So ACL, active, Schedule C, loss, that will help reduce income tax and self-employment tax. If it's a profit, it's ideal to have it as a passive gain, passive business, rent, for instance, on a Schedule E, because Schedule E income, net income, does not generate self-employment tax. Schedule C income, profit, does generate a self-employment tax. So structure your business model around this ACL, active, Schedule C, loss, or PPE, profit, passive, E, Schedule E, and you'll save yourself a bunch of tax. I'm not saying don't dodge the tax rules and laws around that, but create your business model to take advantage of this. And I don't want to get into details on that now, but maybe we could on another session. But that is pretty much it for me. I want to encourage you all to join Tax Resolution Help Center. We want to keep offering these sessions for $19.95 a month. That's a whopping fee, less than a cup of coffee a day or whatever, how much you pay for coffee, I guess. But we'd love your support so we can keep this up. And with that said, I got to get back to work and do some more tax work. And I'll turn it over to you, May, unless you have a couple questions for me.
Oh, yes, we do have a question. This
Okay.
is from one of our attendees in Zoom, from Carol. Her question is, how can I deduct my car in my business? I use it all the time.
Well, it's a good question, Carol. There is called depreciation, and there are several types of depreciation. Um, but the common depreciation method that's used that normally is the better one to use is a mileage deduction depreciation method, where the IRS gives you a certain cents per mile, roughly 50 cents. It varies every year, but it's about 50 cents. Uh, Last year it had, for 6 months, it was less than that. It was 55, 52. Then after later 6 months, it was kind of complicated last year because of the higher price in gases. They gave you a
Mm,
bit of a break, but in
done.
essence, that's a depreciation method. So it's a good, you simply use a formula, and you can get help from somebody or just go online, and we might even just have a session on depreciation methods for an automobile. That's probably worth the topic because it seems like I get that question
Most of the time.
nearly every time I do this. So Carol, couple different methods. If you have a big gain in a big gain in if you had a good year in your self-employment business, and you happen to have bought an automobile and you need a tax deduction, um, you could take a form of accelerated depreciation, depending on the type of automobile, et cetera. But um, the thing that's nice about depreciation is that, let's say you bought a $50,000 car and you only come up with a simple number, 5,000. Say you put $10,000 down. Well, you only put 5,000 into it, and let's say you met the 50% threshold test, some other tests, but I'm just going to speak generally. But your out of pocket was $5,000, but you signed a loan for the other 45,000. Well, you get a tax deduction if you use a certain method of depreciation. You would get a tax deduction for the entire $50,000. Or maybe you don't want that full tax deduction, take 25,000. But the point is that you only parted with 5,000 in cash today, but you got a $50,000 deduction this year. So in a year when you had a good year, and you might want to use that accelerated depreciation versus mileage methods, because let's say you bought the automobile in December and you don't have many miles on it. So you put in 2,000 miles. Well, if you use the mileage method there, you only get a $2,000 mile or $1,000 deduction. Well, that's not nearly as attractive as the other one. So you can spend some time analyzing the different depreciation methods, and it can result in big tax savings without incurring a lot of out-of-pocket uh, expenditure in cash. Now, that said, remember that you wouldn't keep getting that deduction. So what you're doing is accelerating that write-off in year one, and you're losing some or most of that write-off in subsequent years. Still going to deduct gas and some other operating costs, but the cost of the asset, you're kind of accelerating that in year one, for instance.
Okay, great. Thank
That's
you
it.
very much.
Anything else?
Yes, I do have one last question. This is from
Okay.
Facebook,
Okay.
um, from Anonymous. And then his question is it better for me to contribute to an IRA or another retirement plan in my self employment business? I am a single member LLC.
Um, well, it's a good question. I kind of touched on that. It's good to make a self-employment SEP contribution or a combination SEP IRA contribution. So max out the SEP, which is I think is 20% of your profit. So take that one first, and I think you can add another contribution to your IRA. So number one, get the SEP done uh, first, and then if you've got funds available and you still want to get another deduction, then you can get an IRA contribution on top of that as well.
All right. Thank you so much for that, Kelly. Yes, that's our last question for today's session. Anything you want to
Okay.
add?
No, we'll be back next week, and I might talk about that depreciation thing next week. So that's probably what we will focus on next week. Thanks
Uh,
to Carol, I think it was. All right.
All right. Thank you so much. It is
Okay.
definitely beneficial. And thank you, Kelly, for today. Beneficial to
Okay.
learn more from a tax expert in order for us to do a better job in our taxes. And thank you for sharing your ideas and your knowledge. We truly appreciate that and have a wonderful day today.
Okay. Thank you.
All right. So I want to also thank everybody for joining our session for today. And our commitment is to make sure that we are able to help you with your taxes. We do this with the TriTax method, FDIY, do it yourself, DIT, do it together, DIA, do it all. Three methods, one solution. Reduce stress from no IRS or state tax debt. A happier and healthier life. If you are not yet a member, please join for less than $20 per month. We need your support to continue to offer more of these sessions. Since it is now tax season, we have many sessions to help you do a better job of doing your taxes yourself. And of course, if you want help, we have a team of experts who can help you do your tax return for you. Please check our website at taxresolutionhelpcenter.com and please join as a member today for $19.95 per month. And again, thank you all for attending.